Welcome to our lunchtime webinar today. This is going to be a crash course in business valuations. My name is Maria Trevis. I'm the Head of Business Development at Specialist Accounting Solutions. So before we begin, just a bit of housekeeping. This session is being recorded, and to keep our timings within your lunch break, our speakers will present the webinar, and if you have any questions, then there'll be an opportunity at the end to post any questions, ask any questions using the Q&A section of this platform. Our speakers today are Sean Hackemann and Adele Kilbane from Specialist Accounting Solutions, and I'll hand over to them now.
Thanks very much, Maria. Much appreciated. Hi, everyone. Welcome to our webinar, a crash course in business valuations. So my name's Sean Hackemann. I'm the founder and director of Specialist Accounting Solutions. I'm joined today by Adele Kilbane, our senior manager here with us today. So moving on, we're covering this webinar today. We'll be talking for about 20 minutes or so, and then we'll be covering questions in the last 10 minutes or so of this section. So a brief introduction about us. We're a firm of accountancy firm based in Reading. We serve clients nationwide, actually, but predominantly what we provide to them is advisory and financial outsourcing services. And obviously, one of those services within our advisory is business valuations, and that is what we're going to cover in a bit more detail today in this webinar. So I'll now hand you over to my colleague Adele, who's going to cover the next three sections of this webinar today.
Thank you, Sean. So why do you value a business? There are various scenarios that may occur that can be summarised quite simply: the good, the bad, and the ugly. So first, looking at the goods, this will be a non-contentious scenario. You may be selling your shares to an EOT, so an employee ownership transaction. You may be retiring and wanting to sell your shares, or you may be seeking investment. And then looking at the other side, this will be the bad or the ugly. You may be parting ways with your business partner. You may be going through a divorce, so needing to value the business in order to calculate the value of your combined assets. So how do we value a business? There are two main valuation methods that we use. So the first one is the income approach, also known as the discounted cash flow approach. We will run through how to calculate and apply the DCF. And the second approach is the market approach, and we will explain how to derive an earnings multiple and walk you through the formula to calculate this. So comparing these two valuation methods, the income approach is more forward-looking, as this is based on future cash flows, whereas the market approach is based on historical data. Where we can, we try to use both of these approaches to calculate an average value of the business, but this is dependent on what information is supplied to us by management. As for example, the income approach requires a robust forecast. So looking first at the income approach. The discounted cash flow, DCF, is based on the theory that the value of an asset is equal to all future cash flows derived from that asset. So what does that actually mean? Because of the time value of money, we want to translate the future cash flows into the present value. Essentially, DCF is asking the question, what are these amounts worth if I were to pay for them now in one lump sum? In order to calculate this, we need a discount rate. A discount rate is the reverse of the interest rate to determine the present value of the future cash flows. So for example, instead of calculating, say if you have 100 grand with 10% interest, what would the value be in 6 years? The discount rate is the reverse of the interest rate, so we'll calculate what those future cash flows are worth now. The discount rate reflects the relative risk of the investment as well as the time value of money. If you are an investor, the higher the risk, the higher the return that you expect. Therefore, the higher the risk of the investment, the higher the discount rate. The general principle is that the net present value of a cash flow in year 5 will be lower than a net present value of a cash flow in year 1. An extreme example of this is the £5 that you receive tomorrow is worth more than the £5 that you receive in 100 years' time. The discount rate can be calculated by using the weighted average cost of capital, also known as WACC. Businesses are generally financed through both equity and debt, and both of these financing structures have different rates of returns attached to them, so we need to calculate an average rate of return. In addition to calculating the discount rate, robust forecasts are key when preparing a discounted cash flow. So let's have a look now at an example of a DCF. There are two key components. The first one is the forecast period. So in this example, it's years 1 to 5. And then the terminal value, which is calculated from the free cash flows with a discount factor applied to it. So in this example, it's that 512k, which is in the bottom right table. And this terminal value determines a company's value into perpetuity beyond a forecast period. We use a terminal growth rate in order to calculate what the business will generate into perpetuity, and this will typically be inflation rate. The importance of having a robust cash flow with a carefully calculated growth rate comes into play here, as the terminal value is very sensitive to the growth rate, and this takes up a large majority of the discounted cash flow, which in turn is the enterprise value of the business. So in this example here, we can see that the terminal value is 512k, and that makes up 512k of the total 800k enterprise value, which is around 64%. So that shows the importance of getting this terminal value correct in a DCF valuation. I'll pass it back over to Sean now, who will run through the market approach.
Thanks very much, Adele. Much appreciated. So we'll cover off the market approach now. And the way we typically apply the market approach is via a relatively straightforward formula, and that's A times B equals C, where A represents the underlying earnings of the business, B is the earnings multiple, and C is the enterprise value. So in our example here, we can see the underlying earnings are £100,000. Our earnings multiple is 5, and then that means our enterprise value is 500,000. So we'll run through those individual items on the following slides in turn. So let's look at A. What do we use to measure A? Well, we usually use earnings before interest, tax, depreciation and amortization, and that's known as EBITDA. So it's a very popular metric that funders and bankers use, as well as accountants. And it poses a question, well, why EBITDA? Why is it such a popular way of measuring the profitability of a business? Well, first of all, it's the best proxy for cash and therefore profitability. And secondly, it's unaffected by how the business is financed. And that's because you're taking the earnings before the interest is paid. So say, for instance, you'd have two companies, company A and company B, and company A and B are exactly the same in every single aspect, except that company A has got a huge amount of debt, say £2 million worth of debt in the business. Then the profits that you'd calculate based on those two companies would be exactly the same, because we're taking a profit before the interest is being deducted. And that means, in effect, that the EBITDA figure is capital structure neutral. So it irons out any issues around the financing. If we would take the profit after interest is being paid, then obviously that would be quite different between those two businesses. The other thing that we do when we calculate the EBITDA is that we make various adjustments, and I'll go through that in a bit more detail on the following slide. The fourth and final point to make is that we typically look at the last 3 years of earnings, including the current year, to work out the maintainable earnings of the business. And the reason why we do that is to have a sort of a longer time frame to really understand, well, what can we expect, what this business can generate over a longer period of time. If we just look at 1 year in isolation, it wouldn't really be that accurate. Typically, we apply a weighting to the final year, a higher weighting to the final year and a lesser weighting to the earlier years. Sometimes we have to go back a little bit further because there was a big impact, say for instance, due to the pandemic. So we might need to increase the time frame from say 3 to 5 years or from 3 to 4 years. So looking at these adjustments now that we mentioned earlier on, so what adjustments do we typically make? Well, it goes in, there's various categories that these fall into. First of all, there's the exceptional and non-recurring items, for example, the legal fees and bad debt. So what do I mean by that? Say, for example, you had a dispute with a client or an employee, and you had to spend a load of money on legal fees. We would add that back, that cost, because it doesn't really represent the normal running of the business, the normal costs associated with running the business. And then in another instance, say for example, you had a customer that went bust, and sorry, my lights have just gone out because I'm not moving. You had a customer that just went bust, and you need to add that back, that write-off of that debt. Then we would obviously we would add that back as the amount of bad debt written off. But in terms of the exceptional items, that also works in both ways in terms of income as well. So say, for example, you had an exceptional income item where you received COVID grants or you made a profit on the sale of a large asset. Say, for example, you sold a property and you made, say, 200 grand's worth of profits. We would deduct that as well. So it works both ways. You can add back exceptional income, but you also, you can deduct exceptional items, but you can also add them back. The other thing that we do is we add back non-cash items such as depreciation and amortization, and that's obviously assuming that our starting point is operating profit, which tends to have those costs included. In terms of director salaries, we tend to adjust those salaries and apply a market rate, because quite often the way directors of SMEs remunerate themselves is not in line with market rate salaries, and B, the way they pay themselves is usually skewed heavily towards a larger dividend and a very low or minimal PAYE salaries, due to tax reasons. And quite often we find that director salaries vary quite significantly year on year, depending on what their cash requirement is, rather than what the market rate is. So we tend to apply a market rate salary to get a better feel for what it would actually cost to run this business on market rate salaries. So let's have a look at these individual items on a table in the following slide. So this is what this looks like in terms of adjustments. So here we can see we've got our total operating profit. We're adding back depreciation and amortization, so we're adding that back again. Then we've got profit on the sale of this asset that we're deducting. We've got some legal and professional fees that we're adding back as well, and then we've got the director's salaries where we add back the salary that they pay themselves, but then we deduct a market rate salary, and all that gives us then a total adjusted EBITDA, which we then weight based on the most recent years. So we rate that a little bit more highly in 2021, a little bit less in 2020, and even less in 2019. So that's just a sort of an example of how we could potentially do this kind of weighting. So that's our A. Let's move on to our B in our formula. So for B, there's two ways to get the EBITDA multiple. The first one is looking at comparable transactions in the same sector over the last 3 to 5 years. When we do this kind of research, we tend to start off with quite a large cohort of transactions that we look and find. Typically, we find somewhere between 20 and 30 transactions. We use a market database called Market IQ from Experian. So we do a lot of research and find an initial cohort of transactions. We then sort of select those transactions that we find are most suitable out of the cohort that we have initially selected. And then we typically end up somewhere between 5 and 8 transactions to work out an average multiple, which is then applied to the adjusted weighted EBITDA to give us an indicative enterprise value. And there is also another way of getting a earnings multiple, so our B in this formula, and that is using the earnings multiples of companies operating in the same sector, which are listed on stock exchanges. So we try and identify businesses that are in a similar sector. Obviously, it's very difficult to, in some cases, to find companies that are very, very similar, but to be fair, the same applies to transactions. Those multiples then that are used or identified from the companies listed on the stock exchange, they are typically discounted, i.e. lowered when we apply them to SMEs or startups, because obviously the liquidity and there's a lack of liquidity when it comes to SMEs. So that's why we would expect there wouldn't be the same level of EBITDA multiple applied to these smaller businesses in comparison. So that's our B. Moving on to our C. So our C is the enterprise value of the business, and the best way to explain what an enterprise value is by using the analogy of a house. And so let's assume the enterprise value is the value of the house. In this case, it's £500,000, and say you've got a house that you want to sell and you've got a mortgage against that, and that's 200,000. Then your equity in the house is 300,000. So it works the same way as it does for a business. if a business is worth, say, 500,000, which is our enterprise value, so that's what the business is actually worth. If you've got a term loan against that business, and that loan is about £200,000, then if you get paid 500,000 for that business, you the equity holder of those shares will only receive 300,000, and that's on the basis that your business is being acquired and is valued on a debt-free, cash-free basis, i.e. there's no debt in there and there's no excess cash in the business. So that's what we mean by enterprise value. It's the value of the business, and the equity value is the actual value that the shareholders will actually receive. So that's the difference between enterprise value and equity value. It's an important distinction. And there's another actually important point I wanted to make here, is that a lot of founders that we work with in terms of valuation and sort of getting them understanding of the business, they don't know what the difference is between pre-money and post-money valuation. So we thought it'd be a good idea to give an example at this stage as well. So pre-money is the value of the business before any investment is received, and post-money is the value of the business after the value of an investment is received. So here's another example. So say, for example, we've got David and Sally. David and Sally have started a business and they've put £600,000 worth of cash into the business, and that's share capital. So they own 100% of that business. And say they approach Annie and Jonathan to invest further into the business, and they want to invest £400,000. So those are two angel investors, and they put £400,000 worth of cash into that business. Then the angel investors now own 40%, and our founders own 60%. So previously the business was worth 600,000, and which is our pre-money value, and our post-money value is £1 million. So that's the difference between pre-money and post-money valuation. Just thought I'd explain that now. So if we have a look on that basis as some stats here, which we thought would also be quite useful, what the sort of the median pre-money valuation is for businesses in the UK and Ireland over the last few years, and we've used sort of data here published by PitchBook, which is quite helpful. We can see here that angel and seed businesses, pre-money valuation, they tend to sort of be between the 2 and the 3.2 million mark. It does skew slightly upwards here in the final year. And we don't actually know why that is the case, but here, for example, at the early VC stage, we can see it's sort of between 4 and 5.3 million euros, going to 5.4, and then at the late VC stage is sort of 8 to 11, so pretty much double that figure. So it's really interesting to see this sort of theory in real life, in context. What does a pre-money valuation actually mean? We've also got another slide for you here on the deal value as well, in terms of also UK and Ireland, again courtesy of PitchBook. Here we can see angel and seed deals sort of somewhere roughly between 0.5 and 0.8 million euros, and going up to 1.2. Early VC stage somewhere between 1.1 and 1.7 million, going down to 1.6, and then here we can see finally the late VCs sort of pretty much double that amount. So again, quite useful data just to put all this theory into context. What does that actually mean in the market? If we go now and have a look at just one final slide in terms of numbers, we can see here, what percentage is actually being acquired by angel and seed investors, early stage and late stage investors. Again, this is for the 9 months in 2022, but here we can see that in terms of investment in tech, enterprise tech, consumer tech, and fintech businesses, well, what kind of stakes are actually being acquired? We can see here sort of angel level investors take sort of low teen stakes, whereas seed investors getting high 20s, early stage VC low 20s, and then late stage VCs high teens. And actually, interesting enough, the same thing happens here when it comes to consumer tech businesses and seed, as well as early stage and late stage. There's a slightly different trend here when it comes to fintech. Now, I don't actually know why it's so low here in 2021 and 2022, but again, high 20s here, low 20s, and then high teens. So summing up, just some information for you, just to put all this in context, just to sum up in terms of what does all this look like in terms of a valuation report, and how a valuation sort of is undertaken. We have meetings with clients throughout the valuation process. We usually plan our meetings based on the sort of the methodology that we talked through earlier on. We talk them through the earnings multiple once we've sort of found suitable transactions, and research those in detail with them. So we have a call with them at that stage and say, look, this is what we think an appropriate multiple is. Then we have a second meeting with them about the the earnings, the average earnings of the business. So the two parts of our formula are kind of covered in two separate meetings. And then so the clients are aware of that, the direction of travel that we're sort of going towards in terms of our report. We then obviously in the report we combine those values and methods and to conclude on a value, and obviously we present our findings in a comprehensive report. And our research, as I said, that we usually use Market IQ for and various other research tools that obviously that underpins our findings and conclusions. So I just thought I'd demonstrate how the work that we do and or the theory that we've just run through sort of is explained and included in our report. So that's the end of my presentation. Thank you so much for our time. We've got 10 minutes left, and I'll be quite happy to answer any questions you might have at this stage. Thank you very much.
So hi everybody, if you do want to post any questions, you're very welcome to do that in the question and answer section. I do have a question initially. Well, I've got 3 questions actually that were submitted. So maybe Adele could answer this one. Which approach is more accurate for evaluation? Because you were talking about the 2 different types of valuation early on in the presentation.
We wouldn't necessarily say that one is more accurate than the other. The income approach is based on the future, so looking at forecasts, whereas the market approach is based on historical data. So you could say the market approach is more accurate as it's based on actuals. However, it doesn't factor in any growth rate. So we wouldn't really say one is more accurate than the other, but that's why we try to use both of these approaches in our valuations when we can.
Okay, cool. Thank you. The other question I have then is, so maybe for Sean, this one, what are the first steps to a valuer preparing a valuation for me?
What we typically use is the most recent management information. So we usually use current year management accounts, prior year management accounts, and then also we use the most recent statutory accounts, typically with a profit and loss account in it. So we've got more detail on that. And then obviously where there are forecasts, we obtain those forecasts because we need those for our discounted cash flow for our DCF work. And then normally we ask clients about any exceptional items or exceptional income or costs. So we kind of cover that off. And then it's really what's in the financials. Is there anything else that we need to ask them about? Are there any strange, or not strange, but are there any treatments that we need to be aware of from an accounting perspective that are unusual that we need to be aware of? But those are sort of the major first steps.
Cool, thank you. And I suppose maybe one other question that people might be wondering is how long does a valuation normally take?
The process is usually around about 4 weeks. So from start to finish, obviously we typically have around about at least 3 meetings with our clients. So the first one is, as I said, typically going over the earnings multiple, then the average earnings, and then we have a meeting on the draft report as well, and then we finalize the report. But the research phase usually takes a reasonable amount of time, but overall the whole process from start to finish on average is about 4 weeks.
Great, thank you very much. And I can't see any other questions in the Q&A, so just to give you all the heads up. Oh, actually no, there has been one come through. Do you find there are any challenges when it comes to identifying what is surplus cash?
Yeah. I mean, surplus cash is always a sort of something that needs to be looked into in quite a lot of detail. So we usually go back and obtain quite detailed information on the bank on the bankings in terms of the cash balances. So we typically look at the information from a historical perspective and see, where's the minimum cash balance, and then we sort of make assumptions around that, because if you've got quite a long period of time, say the last 1 or 2 years of data in terms of cash balances, of weekly or monthly cash balances, that's probably the most helpful information that we need to establish what excess cash is. But yeah, it is challenging, and we do need to look into it in more detail. Quite often, in particular in an EOT transaction, there are businesses that tend to have quite a lot of excess cash in the business. Sometimes it's just swept into a savings account, so that makes the whole matter relatively straightforward, because what's in the current account is used just for working capital purposes, but other times it's all included in one big pot, and then you really need to do some quite a lot of analysis and to establish what the excess cash is. And usually we have quite a lengthy dialogue or considerable consultation with the client around whether the excess cash figure that we've calculated, whether they think that's reasonable or not.
So you got the light situation again.
Yep.
You just seem too still.
I've just too dark.
So one more follow-on question from Simon. He says, would you recommend any rule of thumb approaches for the amount of working capital that should be left in a business to be included in the enterprise value in that approach?
That's such a good question. The problem is that every business is different, so I don't think rule of thumb approaches really work. So I think for certain sectors you might be able to apply a rule of thumb, but generally speaking, I don't think you can make general statements around that. It's such a tricky area that as I said, you might be able to sort of work it out for a certain sector when you've done a sector beforehand, or say if we do a business where we have some previous experience around it, we'd say, well, we applied this particular approach for this type of business in this sector, and we have, I say, a business that's in the same sector that we do evaluation for, we might be using the same approach. But generally, every business is so different that you can't really do that. And it also might depend on the capital structure, because some businesses have got a lot of debt in them, others don't. So it really does vary a huge amount.
Okay, so every sort of business then taken into the context in which it's assessed and evaluated. Okay.
Yeah.
Great. There don't seem to be any further questions, so I'd like to thank everyone who's attended for their time this morning, lunchtime even, and also thanks to Sean and Adele for their informative insight today. Also, if you do have any time, we'd really love to have your feedback on the webinar today. I will be sending out a survey after this session. So thanks very much. Thanks, Sean and Adele.
Thank you.
And we'll leave you to your coffee and sandwiches. Bye-bye. Thank you. Bye.